So here we are talking about working capital. And what I mean is the cash that you have in a bank account. In this particular reason, I talk about your day-to-day operating account, and I'll be talking about or referencing it as a checking account. The reason this is so important is because my favorite saying is revenue is for vanity, profit is for sanity, but cash is king. And so this entire presentation or series is going to be discussing why it matters and what you can actually do with this information. So it's not just a financial calculation, there's operational decisions you can make as a company with this calculation. So why does it matter? So most importantly, we often look at our KPIs, our key performance indicators, either at the end of a quarter or potentially at the end of each month. But traditionally speaking, we don't have time to do that mid-month. Working capital account is going to give you a really good estimate or benchmark for how your performance is mid-month, and it's going to create a transparent conversation with your employees that you empower to manage this tool. And another big one here is cash conversion cycle. So a lot of companies don't focus on this, but this is a great efficiency metric for the way that you're managing the cash inside of your business. And most importantly, how quickly are you able to take $1 that you spend and create $1.50 or a 50% increase? So how quickly can you create a return? When you go make an expenditure to do a service or a project, how quickly does that money come back and create a positive return, which is what we all want to see. And then also, let's be honest, you can make distribution decisions based on this. It easily aligns your partners or co-business owners on clear and easy KPIs, which sometimes has to wait until the end of the year. And importantly, it also allows you to delegate this cash management. So you don't have to have a really sophisticated accounting infrastructure to do this, but it allows you to communicate and hold accountable an individual or a department that is managing your cash and how efficiently they're doing that. So let's get into the brass tacks of what we actually are doing to calculate this. This is the hard part, quote unquote, in the sense that if you've never done this calculation, every company has a working capital account balance. They just don't necessarily know how they came to that realization, and they don't understand maybe how to adjust it. And so what we do here is we talk specifically about this scenario. And the way I like to start off with your calculation is really you need to understand your AR and AP relationship. Your AR is very simplistically is the receivables or the income that you're receiving for your work. And then your payables is simply the bills. And so what I did was I just laid out a couple of really common bills that you would have to do, and we'll start with the payables. So you have payroll. That happens every 15 days, and each 15-day period you spend about $100,000. So in 1 month, 30 days, you would spend $200,000. Then you go fixed costs, rent, internet. Usually those are on 30-day cycles. Let's say that's about $20,000. And then you have your variable costs. The costs that are going to fluctuate throughout your business that are really hard to predict. And those are 15 days and $20,000. Now, the key thing here is the normalization. So you can't just take 1 month and look at these numbers. What you need to do is you have to look at least 3, preferably 6 months, and take out those expenditures that you know are not normal, and or the same thing with the time periods. And you want to do this for the receivables and the payables. And the idea here is that you come up with a good estimate to compare an apple to an apple. You don't want to have a unique scenario where you have a customer that maybe normally pays in 15, but for whatever reason, they ended up paying in 400 days. Right? That's going to throw off your analysis. So you want to make this as normal and as common as possible, but you want to be honest with when those payables are. And the idea here is for your receivables, you want to focus on when was the service completed, and then when was it actually paid? When did the cash hit your bank account? That's the time period here for these 15 days. And then what most importantly is obviously weighted average. So you have to think about this in the sense of, 30 days for $20,000 is one scenario, but let's say that you have, for this example, you have a 15-day customer, but they only pay $20,000 versus customer number one, they're in 15 days and they pay $100,000. This customer is obviously more important for this analysis. So with this being said, what you'll see is that if you did this weighted average amount, you're going to get 17.4 here, and you're going to get 40K here. And for your receivables, you'll have 42 here, and you'll have 63 here. And what that means, the most important part of this analysis is these two numbers. And really what you see here is a 2.5 difference or delta. And what I mean by that is that 17 goes into 42 about 2.5 times. So you're going to make this payment of $40,000 almost 2.5 times before you get your $63,000. That's an important thing to understand. This isn't where you're going to make a decision, but this is where you really need to understand the relationship between your payables and your receivables. And until you do this analysis, you won't know. But the good thing is this is a very easy figure to pull from your accountant or whoever's controlling your books. And they should be able to just go into your payables and go into your receivables and come up with this difference. And hopefully it's the other way around, but it's pretty common that you have to it takes longer to receive your money than it does to pay your customer or your vendors. Most importantly too is that this is also going to allow you as an owner to put emphasis on certain terms that you may or may not have thought of as an important aspect of your business. And this will give you the ability to go back to potential customers and say, hey, maybe I'll give you a 1% discount if you can go from 120 days to 60 or to 30, because you'll see why that makes a bigger difference. And it's going to put more money in your bank account. It's going to put more money in your pocket, and it'll put more money in your employees' pockets.